Hello all, I hope you people are doing well. So in the last video I have explained you about the functions of central bank, and in that video I have explained about the functions of central bank, in that the currency authority or the bank of issue, and the banker to the government, and bankers bank and supervisor, and the fourth function is it's a controller of money supply and credit. In that I have explained only the three components, that is repo rate, bank rate as well as reverse repo rate. So in today's class I am going to explain you about the open market operation as well as the legal reserve requirements as well as the margin requirements. So when you see the open market operation, so then what does this OMO means? OMO means it refers to the buying and selling of the government securities by the central bank from or to the public as well as commercial banks here. Okay, so that means when the RBI wants to reduce the money supply in the economy, it gonna sells the government securities. It might be the treasury bills, it might be the government bonds here, to whom it will sell to the commercial bank as well as the public here. So now to buy these securities, commercial banks pay the money to the RBI. As a result, what happens? Money goes from the banks to the RBI, and banks will be having less cash available, and the bank's cash reserves gonna decreases. Let me give one example here. Suppose let's say the RBI sells the government bonds, so which is worth of the 5000 crores. Now what happens? Now if you take like SBI, HDFC bank, like that ICICI bank, etc. Now these commercial banks gonna buy these government bonds. Now they will pay 5000 crores to the RBI. Okay, so their cash reserves fall by how much? It's a 5000 crores. So like this, now the banks will be having less money available for giving loans, because the banks are using that money to buy the government bonds here. That is why. So when the banks have the less cash, now they can't able to give many loans here. So if the bank loans decreases, then the credit creation in the economy decreases, and there will be a less money will be circulating in the economy. So now this helps to control the inflation. Okay, so remember, when the RBI wants to increase the money supply, it purchases government securities from the banks. Okay, now the RBI will pay the money to the commercial banks, and this is how now the banks receive the cash, and banks reserve will increase, bank can lend the more. Okay, in that way it works. So always remember, the more cash, I just erase and write. So more reserve means more loans, more deposits, more credit creation, and the higher money supply. Okay, so now this will encourage the investment, this will encourage the production, this will encourage the employment opportunities. So I can just summarize, when the RBI sells the government securities, what happens, and when the RBI purchases the securities, what does happen. So do concentrate. This is a quite easy concept also. If you have any queries, you can just comment. So remember, when the RBI sells the securities, how it gonna affect is, the cash reserve will decrease, and then lending will decrease. If lending decreases, credit creation will decrease. Then money supply will decrease. This is how the inflation will be reduced. And vice versa happens when the RBI purchases the security. When the RBI purchases security, opposite happens. Cash reserve will increase, the lending will increase, credit creation will increase, money supply increases, as well as the investment also increases. Okay, but there are few conditions which are necessary for success of this OMO. The first condition is there should exist a well developed and organized security market. Okay, developed and a well organized security market. What does it mean? That means people and the banks, they should actively buy and sell the government securities. If there is no proper market, means RBI can't conduct OMO effectively. So the thing is, let's say for an example, now India has an organized government securities market. So only RBI can easily buy and sell the securities like that. The second condition is the reserves of the commercial bank should be affected with the sale and purchase of the securities. That means OMO works only if buying and selling securities changes the cash reserves of the bank. Let's say if the bank's reserve don't change, means OMO can't influence lending here. Okay, I hope you people are getting. And the third condition for OMO is the central bank should hold the adequate securities to influence the money supply in the economy. That means RBI should give enough amount of government securities. RBI should have the enough amount of government securities. Only then it can buy or sell them whenever it is required. And the fourth condition is there should not be a frequent fluctuations in the value of the government securities. That means if the price of the government securities change rapidly every day, banks may hesitate to buy or even sell them. So the stable price here, stable price, that will make the OMO effective. That will make the OMO effective. Okay, so I hope you people understood like what is this open market operation, what are the conditions of the open market operation, and what are the effect of the OMO on the sale or purchase of the securities by RBI. So now the fifth function is it's a legal reserve requirement. Okay, which we also call it as variable reserve ratio method. So then what does it mean? It means according to the legal reserve requirements, commercial banks are obliged to maintain some reserves here. It is very quick. It is a direct method to control the credit creating power of commercial bank. That means every commercial bank must keep a certain percentage of its deposits as a reserves. So now these reserves can't be used for giving the loans. This rule is like compulsory. RBI will decide that reserve percentage. Why means, why the commercial bank have to keep a certain percentage as a deposit with RBI is that gonna ensures the safety of our deposits. That ensures the safety of the deposits, that ensures the liquidity, that ensures the financial stability, and that ensures there is a controlled credit creation. Controlled credit creation. Okay, so changing the reserve requirements immediately changes the amount the banks can lend here. Hence, there is something called as CRR and SLR. These two are considered as the direct instruments of the monetary policy. So now we will have a look on the CRR. CRR means it's a cash reserve ratio. As the word itself says, it is a minimum percentage of the net demand and time liabilities you have that is kept by the commercial banks with the central bank. So that means the CRR is like the percentage of deposit that every commercial banks must keep with RBI as a cash itself. Okay, in the form of cash itself. And the bank can't use this money for the lending purpose. Let's say now the total deposit received by a bank in a month is 1,000 crores. Let's say RBI fixed a CRR as a 4%. Then what happens? Then the amount kept with the RBI will be 4% of the 1,000 crores, approximately 40 crores. So now banks can lend only the remaining 960 crores. Okay, this is before considering SLR. Now the remaining 960 crores it is ready to lend, and this 40 crore now the commercial banks have to keep as a reserve with the RBI. That is a cash reserve ratio. And basically here what happens, if there is increase in CRR, so the increase in CRR means, let's say if the CRR increased from the 4% to the 6%. Okay, earlier reserve how much they were keeping? They were keeping 40 crores. And now the reserves is like 60 crores. Now the banks have only like, let's say like 20 crores to lend here. Then what happens if the RBI increases CRR means that will reduce the lending. Increase in CRR means lending gonna decreases. If lending decreases, credit creation decreases and overall money supply decreases. And vice versa happens if there is a decrease in the CRR. If the central bank decreases the cash reserve means more money will be available with the commercial banks. So they can lend more money. So lending increases at the time. In turn, credit creation increases, money supply also increases. Okay, you can just connect that CRR with loans and money supply, as it is a quite easy to remember the trick. Like CRR, you are connecting with loans and with the money supply. And next comes the statutory liquidity ratio. Statutory liquidity ratio. So this is the second type of legal requirement. I hope you understood what is CRR mean. And now comes the SLR. SLR means unlike the CRR, here the SLR is kept by the commercial bank itself, not with the RBI. Okay, the banks are required to maintain with themselves here. So banks maintain SLR in the form of cash, in the form of gold, in the form of government approved securities. But in the cash reserve ratio, you're gonna keep with RBI in the form of only cash. But SLR means you're gonna keep in the form of cash, gold, or else any government approved securities. Okay, so here also the SLR is maintained in the form of designated liquid assets here. It might be liquid assets means it might be the cash, it might be gold, it might be government security, it might be even any other approved securities also, where these assets can be converted into the cash very quickly. So in that way, increase in the SLR. Now let's see how does this increase in SLR gonna affect. So if the central bank increases the SLR means banks must keep more liquid assets with themselves. Bank must keep more liquid assets with themselves. So if the bank keeps less money for themselves means the banks will be having less money to lend here. Because of this what happened? Because of this credit will be decreases and money supply also decreases. Okay, in the same way, opposite to that to increase in SLR, if you take decrease in SLR, That means banks are keeping very few reserves here for themselves. Okay, that means if they are keeping less reserve means banks will be having more money to lend. Banks having more money to lend. If banks have more money to lend means of course they'll give more loans. So credit increases. In turns money supply also increases in economy. So in this way you can connect the CRR and SLR. Okay. So the next topic is it's a margin requirements. It's a margin requirements. So what is this margin requirement? Margin requirement means this is a difference between the amount of loan and the market value of security offered by the borrower against the loan here. That means when a person takes a loans against an asset, it might be a gold, it might be the shares, it might be the property, etc. Then the bank doesn't give a loan equal to the full value of that asset. Now the difference between this market value of security and the loan amount, we call it as a margin here. Okay, you can just write this formula just to understand in a better way. Margin means the value of security minus the loan taken or the loan amount here. Suppose for an example, the value of gold which you get for as a security purposes, let's assume that it's a 10 lakh rupee, and now the bank gives you the loan. Bank gives the loan which is worth of 7 lakh. How much the margin? Now the margin is, it's a 3 lakh. Okay, now it's that simple. So let's say here according to the textbook example, if the margin fixed by the central bank is 40%, now the remaining 60%, okay, so now the commercial banks are allowed to give a loan only up to 60% of the value of security. So like that means let's say if the property value is 10 lakh, the margin fixed by central bank is 40% means only the commercial banks can lend 60% of the loan. That means they can only lend 6 lakhs here. That is a maximum loan now which the commercial banks can lend to the borrower here. That is a margin. So now let's understand what happens if the RBI increases margin, how it gonna affect on the credit creation, and what if the RBI decreases margin and how that will affect to the money supply in the economy. So carefully observe, if RBI increases margin means, let's say the margin increases from 40% to the 60%. Okay, so let me assume that the property value is 10 lakh. Earlier, how much they could have taken the loan when the margin was 40%. Now they would have took 6 lakh as a loan to that like a collateral or the security. But now it's a 4 lakh. It's a 4 lakh only loan they get, even though they are keeping 10 lakh property value as a collateral here. That means now the bank is lending less. Bank lend very less. Because of this, credit creation decreases and money supply decreases. And the vice versa happens if the RBI decreases the margin here. Okay, so I hope you people understood clearly what is open market operation, what is CRR, what is SLR, and what is the margin requirements here. So if you have any doubt in these topics, you can just text me in the comment section. I will try to reply there, or else I will take that question in the next video. If you haven't watched the other functions of central bank it, you can watch. So thank you. Have a nice day.